have to say, I'm genuinely pissed off. And where we are right now in the economic cycle is one that is so obvious, it's almost sickening that Wall Street continues to lie to you. Now, specifically why I'm pissed off, it's not necessarily that Wall Street is lying to you. It is, but it's not. It is that I actually have a passion for, one, telling you how it is, telling the truth, good or bad that's going on in the economy, but deeper than that, helping people make the best decision with the knowledge that they have available to better their families, okay? If you take in good information that is accurate, then that can help you formulate a better opinion to ultimately make more money, that is a good thing. You are served well by that. If you take in all of these lies and these opinion pieces from what generally Wall Street is doing right now, even the Fed is lying to you, and that's obvious. They are hurting your ability to generate safety, comfortability, prosperity for your family, and that's the part that really gets to me. While at the same time, the individuals that are actually being honest with you are the outliers. They're the ones that are being criticized and, well, rejected. So with that said, let me start with this. I think markets in the near term can actually go higher. I think part of this is a sugar high. I think part of this is because we've been waiting for rates to be cut for so long. And yes, when the Fed reduces rates, there is a lower chance of a recession. Considering the economic data that we currently have shows the US economy is not in a recession. Now, whether or not that is accurate, or we could be heading off of a cliff as kind of Goolsbee suggested today, well, that's something we just don't know. But for those reasons, I think you could actually see a rally in markets in the short term. And I've talked about this before, where September is a month that tends to historically be pretty negative. I actually think this time around, it could actually be pretty positive. Again, not too many Septembers do we have the end of a hiking cycle and the start of a cutting cycle. The last time that happened was September 18th, 2007, when the Fed cut rates 50 basis points, and markets actually rallied for 3 weeks after that. So there is some historical precedence that would suggest this September could be a good one. Now, we do have some economic data throughout the rest of this week and some Fed speakers, but I generally think the Fed's going to be pretty bullish. I think the data is probably going to come in line with estimates, and things are going to be just fine. Now, if you guys have not followed me already on X, I highly recommend you do, because I just tell it how it is. If it's good, then we will acknowledge it. If it's bad, we will acknowledge it. And unfortunately, I see a lot of people lying to you. And I guess some of this video, or most of this video, was actually kind of thought of because of this post I seen from Dan Niles. To be honest, I didn't even read the whole post. I don't think you have to. He's basically saying that now the Fed is cutting rates. You don't want to fight the Fed, because now the Fed is cutting rates. And I really stopped reading this post once I got to this point. Dan Niles says, my view continues to be that this is the first of many new all-time highs, given the market knows the Fed will be even more aggressive on any sign of economic trouble during its rate cutting cycle. I feel like for someone that makes a lot of money, that manages people's money, should have a little bit more financial competence. And let's go back to this term, fight the Fed, because this is a very interesting term. Fight the Fed implies that obviously you're doing the opposite of what the Fed wants you to do, or you should do during a period in time. When in fact, markets were fighting the Fed in 2022, when stocks were declining. Stocks actually normally go up during rate hiking cycles. I wrote this post on X that says, want to know a secret nobody on Wall Street will tell you? If you are bullish, you are fighting the Fed. In fact, when the Fed raises rates, historically stocks do just fine. It isn't until the Fed cuts rates that you want to panic. You're welcome. Because if you look at any time from really the 80s until now, you can look at this prior and it still works, but let's just look at a smaller time frame with 4 definitive recessions in the meantime. Anytime the Fed was actually raising rates was a good period in markets, okay? From the period of 1988 or so to 1990, the Fed was raising rates. Unemployment rate was falling. Stocks were doing just fine during this period. And then you went into a recession, unemployment rate rose, and the Fed started to cut more aggressively, But even here, when the Fed started cutting rates in early 1990, it was probably a sign that maybe things were going to get bad. Maybe it was time to not be so allocated in markets. Okay, great. From the period of 1994 or so, the unemployment rate had been falling already. The Fed started raising rates. And yes, it was kind of up and down. The Fed adjusted policy a little bit during this time frame, but the entire time the unemployment rate was actually falling. It wasn't until 2000s that the Fed started cutting rates, and then you went into a recession and stocks did poorly. You made a lot of money if you invested in the markets from 1994 through 2000, when the Fed was actually raising rates from about 2.75% up to a high of about 6.5%. You actually did very well during this period in time. It wasn't until the Fed cut rates that you actually wanted to get out of markets. Now, more recently, from 2004 through 2007, the Fed raised rates from 0.25% up to 5.25%. The unemployment rate was declining the entire time. Stocks did very well from 2004 through 2007, started 2008. Okay. This was a great time to be invested in markets. It wasn't until the Fed cut rates that you actually wanted to panic, essentially. Even more recently, from 2015, where the federal funds rate was at 0, through 2019, when the Fed raised rates to 2.5%, unemployment rate was declining, and this was a great time to be in markets. What happened when the Fed started cutting rates? Late 2019. You can argue that we knew COVID was coming. You could argue that the bond market knew that. You could argue that the economy just looked like it was slowing down regardless, and that's why the Fed was cutting rates. Either way you put it, when the Fed started to cut rates in late 2019, it was probably a good time to panic, to get out of markets. And that held true into the Rona recession. Nowadays, we have an unemployment rate that was falling. The Fed did not raise rates. Clearly, they got way behind the curve here because that's not what you normally do. Normally, when the unemployment rate is falling, you tend to raise rates to slow down the economy. Now the unemployment rate is rise. So that was already, again, mistake number 1 from the Fed, where they deviated from what they normally do. But the unemployment rate is now rising as the Fed was rapidly raising rates. Great. Now we've been plateaued on the federal funds rate until just last week, when the Fed cut rates into a rising unemployment rate. This is historically when you want to panic, like by definition. And I think it's even more frustrating because markets are not cheap. They are in fact priced for almost 20% S&P 500 EPS growth for next year. Like, there is no pricing in of risk here. There is no semblance of risk management. Nothing. And historical precedents would tell us, at bare minimum, we're not going to have a good period in markets coming over the next, what could be years, potentially. Now, I don't think we're at the point where we can say we're going to have a super deep recession. I think you do need to see a 2 standard deviation black swan event or something greater. A 2 standard deviation black swan event, by my definition, would be like a First Republic size bank, $100 billion bank, going bankrupt again, going out of business. If that were to happen now, I think that would be a catalyst to push us into a recession. Maybe that could be a really bad, retail sales report, like decisively, like scratch your head, economy's falling out of bed, bad report. Could be something else, okay? But a 2 standard deviation black swan event implies something that is not super likely to happen, but not that unlikely at the same time. Like a really bad event that has a low likelihood of happening, but not like a COVID low likelihood. Like COVID low likelihood is like a tenth of 1%, right? It's just, or 1% maybe if you have a pandemic every 10 years or so. I would say a 2 standard deviation black swan event is like a 10 to 15% likelihood, right? So I think if we're using mathematics here, that's probably this a ballpark of the likelihood of like a 2007, 2008 deep, unemployment recession. So I want to be clear. I'm not really in that camp either, although that is a possibility that Wall Street will not even consider at this point. Now, I also wrote this post on X that says the amount of listed homes for sale in the US has almost tripled since March of 2022. Wall Street, let me ask you, what happens when supply increases way more than demand? I write here, I bet 9 out of 10 Wall Streeters get this wrong. Now let me ask this. What do we think will happen to the economy when the housing market rolls over? And you can see here, we were sitting at about 354,000 listings in the US back in March of 2022. Today, we're at 909,000 listings. At the same time, the purchase applications to buy a home have collapsed since 2022. Homes are going on the market. They are sitting on the market. And there is very little demand out there to buy a new home. This will become very problematic for the broader economy if the housing market does start to roll over. In which, honestly, looking at this data, it's really just a matter of time before home values start to get compressed and sent lower. And simple supply and demand dynamics, something you'd learn in like an Econ 101 class, like maybe in high school or early college, would be if supply rises more than demand, prices will fall, okay? But as you grow that disparity, if you grow that gap between supply growing at what's more than 3 times the pace, including the decline in mortgage applications, you're looking at 5 to 10 times the pace of supply that's outpacing demand, then you can really start to see some negative pressures on price. Now, we haven't seen that as much so far for immigration reasons, other different reasons, but it's coming. And that's some data that I just kind of put together today that did not help my confidence in the slightest that markets are appropriately priced here. Because if you're an equity strategist, in other words, an equity investor, if you buy or sell stocks, then the question that you need to be asking yourself always, no matter if you're in a good or bad market, is, are markets priced correctly? Now, judging off all of this data that I've shared with you really over the last couple of weeks, pointing out the Fed's lies, some government lies here and there, you start to draw the conclusion that the vastly more likely statistical outcome is the markets are dramatically mispriced. Like not by a little bit, but potentially by a lot. And that's where I think a lot of Wall Street refusing to acknowledge anything that me or others talk about in these videos or posts on X perhaps is really becoming detrimental to some people's financial well-being. By all means, if you have a stable job you've been at for a long time, you have seniority, you do a great job, and you just buy and hold, you buy when it's low, you buy when things are high, then you'll be just fine. Just keep doing what you're doing. But if you are someone that watches these videos, if you are actively invested in our markets, then I think having a heads up that a 30 to 50% decline in markets could come is probably better for you to know than not. Now, again, I think a 50% decline would be something like a great financial crisis, like recession with unemployment that just continues to soar. And I think the odds of that are 10 to 15%. Like, I don't think they're high, and that's not the base case assumption. But just heading close to a recession, not going into a recession, like we seen in 2022 could easily give you 20 to 30% downside. Actually, heading into a recession could give you easily 30 to 40% downside, no matter really how deep it is, if it's just a shallow recession even. And then obviously if you get something that's like a deep recession, then you're looking at 50+% downside, given just how elevated market's expectations are. Now, Fed Goolsbee also said something that was very interesting today that I think a lot of Wall Street missed and they won't tell you about, because let's be honest, a lot of guys on Wall Street, they're trying to keep their clients. If you go out and you spook investors, if you tell investors, what's really going on out there in the economy, how mispriced markets are, you're going to lose investors, you're going to lose clients. I don't have investors or clients, so I do not care. Okay, I do not care if you want to stay ill-informed, then don't watch these videos. That's just fine. If you want to stay informed and you want to make the best financial decision for your family, by all means, watch the videos, share them with your friends, your family, your pals, whoever else. Fed Goolsbee said today, prices go up before cost, saying that margins get boosted first, right? And then costs go up and compress margins. So they get compressed down again as your costs actually start to go up, as wages go up, as inflationary pressures start to go up. Basically implying that we could see some margin compression that could be starting soon, which again is something Wall Street will not tell you. And now prices are not going up and costs are continuing to go up for companies and prices are not going up faster. So yes, that margin compression could be coming over the coming quarters. You also had a pretty crazy S&P Flash PMI report today. In the employment and capacity component of this report, it says employment fell for a second month running in September and has now fallen in 4 of the last 6 months. That said, the overall decline was only very modest and less than reported in August amid reduced job losses in the services economy. The decline in service jobs was often linked to difficulties replacing leavers, though the addition of new staff was curbed by uncertainty about the outlook. It's really the manufacturing aspect of this that is just outright scary. It says manufacturing payrolls were meanwhile cut at a pace not recorded since June of 2020. Excluding the pandemic, the decline in factory jobs was the steepest since January of 2010, as an increased number of firms reported the need to reduce operating capacity in line with weak sales. So manufacturing jobs or factory jobs are actually being lost right now at the fastest pace since the early recovery of the 08-09 recession, which is, pretty alarming. And these companies are citing weak sales. I don't think that sounds good heading into Q3 earnings season, which starts over the next couple of weeks. Again, now have I seen any of these arguments anywhere on X at all? No, I haven't. You have to do your own independent research to find these things. And I like to give the benefit of the doubt to Wall Streeters and say they're not that stupid. That there's obviously some kind of malicious intent that is here because they don't want to tell you things. They don't want to spook their clients. And I think that is a moral hazard. And unfortunately, I will not follow that status quo. And I don't want to, don't have to, because I don't have clients. And I don't make millions of dollars selling optimism more than pessimism. Actually, in fact, making these videos are pretty well disliked by most people, because most people tend to want to be optimistic, and I am very optimistic on America's long-term future. Again, if you're just a long-term investor, you don't care about price, just buy. But if you're watching this video, you probably to some degree are more financially inclined. You are able to take in information and make a assessment for yourself, in which one time might be a better time to put more money to work than others. And that's the ultimate goal here, is to give you the unbiased perspective of what's going on in our markets and in the economy. And unfortunately, with markets as high as they are, I can't build any bullish case for markets here. Like, it's literally impossible from my standpoint. What are you going to get? More margin improvement on multiple improvement upon multiples that are already sitting at multi-year highs, that are already factoring in hundreds of basis points of Fed cuts over the next year. What are you going to price in greater than 18% EPS growth for the S&P 500 year over year in a time in which the economy is dramatically weakening in literal real time? Like, there is no upside case for markets at this point. There's just not. There's just not. And I think that's what Wall Street will not tell you. And you're seeing this on CNBC, on Bloomberg, on basically everywhere you go. The bears are far and few. The bulls are everywhere. And I think that in and of itself is kind of scary, huh? So yeah, you guys have a great rest of your day. That is going to go ahead and conclude this video. Can you say bye? Say bye. Say bye. Say bye.
Bye.